Art, welcome back. Good to see you again. Let's cut right to the chase. What are these unconventional safety plays, and why are they safe now when you wouldn't typically think of them as being so?
Yeah, thanks so much for having me. Great question. I think when we think about defensives and the safety plays, what happens is everybody's thinking about it at the same time. So a lot of those groups, the staples, the utilities, telecom operators, the REITs have gotten a bit stretched, and as a lot of sectors have. So I think that's one of our issues right now. So when you think about safety, defensible cash flows, shareholder-friendly managements, first company that comes to mind obviously is Apple. I think when they report on Thursday, they've beaten 8 out of the last 8 quarters. They're likely to beat again. I think analyst estimate revisions have been moving higher throughout the quarter and will likely do so into the second quarter. I think that when we think about the multiple they're trading at 26 times. If you backed out that cash component, it'd be trading at a market multiple right now for a company that's growing about twice as fast as the S&P in terms of earnings and revenue. So I think that's one defensive way to play this, and certainly 10-12% off of its all-time highs.
Now,
second name would
I was going to say, now REITs are another area, an area that you said, typically maybe aren't the defensive plays they used to be, but your next pick is a REIT, a so-called net lease REIT. You got to remind me what those are and why this one is a good one, W.P. Carey.
Yeah, W.P. Carey's been around for a long time, about a $16 billion market cap company. It's grown its earnings and it's grown its dividend payout consistently over the last 25 years. It's throwing off about a 5% dividend. I think what's different here is they actually are going to be much more diversified than any typical REIT that sits in one sector. So they're diversified both with geographies, and they're diversified with product type. And they've got a great management team that continues to find the right cap rates, pays a consistent dividend, and I think this is one of those REITs that is actually going to be defensible in this environment, throwing off a 5% dividend with the yield on a 10-year poking up at or about 3% at the close of business last week.
But it's interesting, Art, and this is Kelly here, to note that at a time when people are getting fed up with mega cap tech, maybe less so than smaller tech, but a little fed up with the whole space, you're saying now might be the time to tiptoe back in?
Yeah, well, what's interesting, Kelly, we've seen this throughout the course of this year, and clearly in the month of April, is that when we are in a risk-off environment and yields are moving higher as they have precipitously over the course of, call it the last 2 months, the growth rate really gets punished. And the growth rate sort of encompasses all of technology. So while it's harder to defend some of those price to sales or price to revenue disruptors, it's a lot easier to defend companies that actually have defensible moats, steady cash flow, growing earnings are measured on a multiple to earnings. So we think Apple fits all of those, and there's likely a couple other names that are reporting this week that fall into that category. So when we think about technology, we like to bifurcate that with the haves and the have-nots, and right now the have-nots are clearly those fast revenue growers that are pre-earnings, and the haves really are the stocks that have actually been sold off, but not focusing on what they really should be worth. And I think right here and now, Apple's probably got a very defensible multiple.